Welcome everyone to the second in a series of webinars hosted by the African Development Bank and Allan Gray. Today's webinar will be discussing African listed bonds with a focus on sovereign and corporate issues. My name is Jamil Toyo. I'm joining you from Johannesburg. I will be your moderator for this event. Joining me on the virtual stage are three excellent speakers in various parts of the world. They'll be coming in with different perspectives on this specific topic. Okay, I think we can get right into this, to our first speaker. The first speaker will be Mr. Celestin Rwabukumba, who will be discussing African capital markets, challenges and opportunities. Welcome, Celestin. Thank you for joining us. I'm going to hand over to you to please take us along. Thank you.
Thank you for having me on this webinar. It's such a pleasure for me. I think the topic is very straightforward. From the perspective of African exchanges, I think we've had long discussions within our ASEA fraternity. We do have our conferences every annual conference and AGM every November. Unfortunately, this time around we will do it with the new normal. But normally we meet and then discuss issues, papers, and challenges and opportunities laying ahead. But specifically for this one of today, looking particularly on the bond markets on the continent, and participation of foreign investors in local capital markets and so on. I've tried to look at the generalities we have in this particular topic. So first of all, I just wanted to look at the whole continent in our stock market. The first time we had a stock market in this whole continent was in 1861. So that basically, it's 15 decades now. So we are home to 36 exchanges, serving about 43 economies and representing 1,400 listed companies with a turnover of $41 billion. So maybe here I could add also the most recent one, which was born recently, the Victoria Falls exchange that came up, I think was last month or so. Basically, we have many exchanges serving these economies, but most of them are not big enough to sustain themselves or work efficiently or function efficiently as in the advanced world. So, but there has been also big successful fundraising initiatives by multilateral entities such as the African Development Bank and the Trade Development Bank, and they still support our markets through issuance of local denominated instruments, which demonstrates over time that our markets have been growing. Of course, not at the rate we wish them to do, but they have been growing. So the third one is one of the main challenges we see across. I'm talking about the generalities. In general, what most the continent has in our bonds market development and participation from foreign or even domestic investors, we are all being characterized as being illiquid and highly fragmented, and we are operating under weak regulatory environments. So this categorization is supported by additional activities on our exchanges and shrinking foreign investor participation across the markets. So if you look at the statistics we've been having around in the markets across the board, that is, I'm talking about before COVID. We've had many issues happening in our markets, but this is basically in general. I would mention maybe issues of technology and leakages and so on. But if I go specifically to specific countries, I will just be dashing. I'll have a challenges dashboard basically for the different markets. If you go to the challenges we have in the and the PSC, for example, and in Botswana, the fragmentation of their bond markets between the PSC itself, for example, and the commercial banks overseen by the Botswana Central Bank. So there is a problem of dissemination of price information, price discovery, computation of bond indices, transaction costs, and the perceived risks of the market, retail investor access, international investor participation, and so on. So these issues, they're not relating only to the market in Botswana alone. We can all relate on these issues. Basically, the issue of fragmentation is very, very, very paramount, very serious issue we are having because of the nature of our bonds market, and not the issue of us alone, not even seeing it the same way in different markets. It's not all the markets, but most markets are facing the same issue, whereby you see the bonds market are not developing because of some of the regulatory issues they have in their markets, and the dominance of central banks alone, and they are not really coordinating with the exchanges to make sure that the entire ecosystem is talking the same language. So you find that because of the size of our markets, we don't have enough traction when it comes down to that. So we'll see that when we talk about some of the proposed recommendations under the ASEA, because most of these we derived from our own experiences and the studies that were done before by different institutions. And mainly we're borrowing a lot from the CFA Institute, which we collaborate to a greater extent. So these structural challenges, they go as to the level of development itself. We have not developed yet enough our debt markets. And the other issue we face comes with the unstable policy making from time to time. If you borrow a leaf from the Zimbabwean experience, for example, in 2009, where they adopted the use of the US dollar and the other currencies, foreign currencies, and then they abolished in 2019. So to introduce the ZIM, the RTGS dollar, and this one has worked against actually the policy itself. So looking at that, and coupled with, for example, the political instability that they had thereafter, this whole thing has become a mess. So I believe maybe some people in the audience would have more to say about this, but it's very important for us as we continue developing our markets and attracting serious investors. So our own macro and monetary policies and our own fiscal challenges arise across the board, but one good example would be the Namibia. I can borrow it from Namibia, where just the country had one of the lowest GDP ratio in the world, okay, until 2011. But for 6 years later, in 2017, the two international rating agencies that cover Namibia downgraded the country to a sub-investment grade rating, citing among other issues the rapid rise in public debt. So, it goes across the board. But some of those challenges are there. We still have them, but the different markets or countries have tried to address them by innovating, creating different initiatives that are helping from all the different exchanges we've seen. Citing the South African market, for example, the City World Government Bond Index, inclusion listing 12 government bonds with a market value of 93.8 billion. So that one has gained, that has helped the market to gain greater exposure to global markets and the attention of international investors and asset managers across the board. So the decision also policy-wise for allowing the inward listing rules, the JSE has allowed foreign domiciled companies to be treated as domestic listings, while foreign firms have been allowed to list on a JSE back in 2004. So we've seen the progress in that market caused by the few initiatives of innovation and adapting to international standards. So the same innovations or adjusting our legal framework and policy framework, we see it also in the BSC in Botswana, where they have been trying to promote cross listings, and they adjusted their legal frameworks, which has helped them increase their own uptake. So the issues of liquidity, of course, remain at large for most of the markets, and some of the issues or remedies, we'll see them after, in the back of my presentation, whereby we've come up with a few, maybe I would say, recommendations within our exchanges fora. So if we go down to East Africa, these changes go across the markets, and the remedy is almost still also the same. So if you look at back here in East Africa, we try to, the biggest thing we are working on as East African community, because the same issues still persist of having fragmented markets and having low technology and policy frameworks which are not adjusted or innovative enough. We've tried to, on the East African community, we are talking about the capital market infrastructure, whereby the East African community countries are trying to bring all together, link their markets so that we can have a larger pool, a wider pool of investors together and issuers, and both governments and corporates. Institutional investors, mutual funds, and foreigners are the main investors in our equities, but the bonds market are not really are not taken that much seriously.
Hi everyone. Apologies for that. It appears that we may have lost Celestin in the middle of his presentation. I think I'm just going to maybe try to move on to the next presenter so that we don't kind of lose too much time. I think from his presentation, it seems to me that the challenges he describes are really, they spring from the kind of obvious structural and economic and political challenges that we have on the continent. And you see that being reflected in the capital markets in the form of sort of the smaller size exchanges and, the illiquidity and, the fragmentation, so on and so forth, and the policy uncertainty. And all of these things, they present the challenges that we're facing. And I think he was just in the process of discussing some of the opportunities and solutions that he has been a part of rolling out, certainly in East Africa. It feeds into our second presenter, or the second topic that we're presenting. And that's going to be presented by Mr. Stefan Nalletamby. He'll be talking to us about the African Exchanges Linkage Project. I hadn't heard about this project before now, but I did have a early look at what it's about, and I must say I'm quite excited to hear about all the interesting things that he's going to be talking about. Good afternoon, Stefan. I believe it is afternoon in Abidjan. Thank you for joining us. I'm looking forward to your presentation. I'm going to let you take us forward from here. Thank you.
Yes, good afternoon, Jamil, and good afternoon, everybody. Great. So good afternoon, everybody, and it's a pleasure to be with you all. And Jamil, I'm pleased to hear that now you've at least got some insights into the Africa Exchange Project. Celestin has given us basically the background and the usual topics that we all agree are the main challenges that we have in the capital markets. And one of them that we looked at, the AfDB, and in fact, we discussed this with ASEA for many years, and ASEA had been hounding us to find a way to help them, and we finally did. So we're very pleased to be able to support this project, which of course is just one way to contribute to improving the cross-border trading, if I may say. But anyway, I'll get into all that. So you've seen all the different exchanges here on the front page, and I'll move straight to the presentation. And here's the outline. It's really about presenting what this exchange linkages project will do, hopefully, knowing that we are we've moved quite far along the road. We actually have the project coordinator, I think, who's in the audience. So hopefully he can come in if I say something silly along the way. Okay, thanks. So as I said, thanks working with the ASEA on this ALP as a regional approach to capital market development through creating linkages among several stock exchanges. The idea is we can be linking 7 major African stock exchanges and enable a seamless cross-border investment flows through a Pan-African securities trading system. Now, the first phase is with 7 major security exchanges. That's Egypt, South Africa, Nigeria, Morocco, Kenya, Mauritius, and the YMU BRVM. And it's going to cover basically around capitalization of 1 trillion, which is about 90% of the stock market capitalization today. How the bank has been able to help, it's in fact, we managed to mobilize the Korean Trust Fund, the KWAFEC, Korean Africa Economic Cooperation Trust Fund, to support us in providing $1 million, which sounds very small, but in fact, from let's say, I would say from a mobilizing effect, it's been extremely relevant to the ASEA in really getting things off the ground. And you'll see when I go through the presentation that it has helped us go far. So the ALP is expected to help address the lack of depth and liquidity, which Celestin was referring to, supporting seamless trading and settlement of transactions, and allowing savings to be pooled across the region, facilitating cost and information sharing and risk diversification. And of course, as we mentioned, you'll see as I say it further down, this covers all the products of the stock exchanges. It's not about equities alone. So really the expected outcomes is, and I'll just name a few, and really I'd like to focus on the linkages and the visibility to domestic and global institutional investors. And as we heard from Celestin, the international investors seem to have been shying away a bit more. So we need to be mobilizing more domestic investors. And what is important, of course, is the investment products. Equities mainly. There are some bonds, derivatives are quite high. ETFs, REITs, and the others, these new products are still very minute. And of course, there's a strong bias to South Africa, because as you can see, it's close to, I think, about 84% of the global capitalization of our stock market. So of course, there's a huge proportion of the derivatives that are exchanged on the JSE. But we know that in Casablanca, they've started, Nairobi, they're starting, in Egypt also. So there are, and Mauritius. So there is a diversification that is ongoing in our different markets, and this is important. On terms of the value add, as I mentioned, it's really about, this is really summarizes what I mentioned earlier on. What is important to really note here is that we have the diverse products that people will be able to access through a one-stop shop approach. Because at the end of the day, what you'll be doing is you have a broker in Egypt, you'll be able to settle securities that you're willing to buy in a different market, one of the 7 obviously, and I'll explain how that works a bit later on. But it's extremely important to understand that this is about increasing the visibility of our markets and enabling technology to support us in getting over certain hurdles. Of course, not all, because we know there's some legal issues and regulatory issues that we have to discuss. So how did we choose these different markets to join the first phase? It was, of course, linked to a market readiness study. And here we have the criteria. There's 6 of them. And these 7 parties, of course, had to be willing to join. And of course, this was within the framework of discussions in ASEA. And so it took us over 2 years before we finally found the money. And of course, it helped us also have a more mature proposal to submit to the Koreans and make sure that we were in line with what they could, where they could assist us. On the grant from Korea, what is very important to realize, it's very much linked to information technology and capacity building. And of course, we've put in place a project management office that is based out of the Nairobi Stock Exchange, the secretariat of the Stock Exchange. And it's important that we see that this has been able to trigger, if I may say, a whole new approach to actually engaging in this securities and stockbroker work on the continent. Why I say that is, in fact, this comes to this page. We've actually established through the creation of this work together at ASIA, we've actually engaged with a lot of the stakeholders, and of course the securities dealers and stockbrokers are crucial for this to actually even see the light of day. Because you can well imagine there's competing interests, and we had to make sure that we had their buy-in, and from the outset, we organized these different discussions, and it led to us creating this African Stockbrokers and Security Dealers Association, which is still in early days, but is extremely crucial that we have them involved. And of course, it will be we will be promoting through this approach of having this ASDA created, the sponsored access model approach. And it's going to help us also allow the smaller brokers, even in smaller brokers, to be able to access through the larger ones in country, to be able to support their specific clients on accessing different markets across the continent. And of course, the AFCFTA, as you all know, has been approved and is now implemented. It has its established its secretariat in Accra. So we are definitely in the right direction, because all this will help show that we can establish these single and liberalized market approaches and basically meet the challenges that we have to show that there's a real drive for the continent to be able to be more easily accessible and less fragmented, that, as was mentioned by Celestin. So right now we're in the procurement, which is always the big part of the discussion, the procurement of the linked technology platform. And as you're well aware, we're going to make sure this technology is something that is forward-looking and will be adaptable to the new situations that will occur in the coming years and the new technological advances. And of course, we're disseminating and communicating constantly on these on this platform. And unfortunately, I see that Jamil had not been communicated to, but now he has. Now to how this links with the African Development Bank's work in the capital markets. But of course, you know, we're not the only players in this space. We work a lot with partners, we partner a lot with others, but we also want to make sure that beyond partnering with others, our mantra is really to make sure that we do support development of local financing, the usage of local financing and the churning of money within our systems. Why do we do that? Because we believe that no country will ever develop if it depends on foreign money to develop it. So we are convinced that we need to make sure that these local markets, be they equity markets, be they bond markets, be they real estate markets, they have to be monetized in such a manner through the stock exchange, or maybe not through the stock exchange, but they have to be monetized in such a manner that they will be supporting the capital market, the development of the economy. And capital markets is just one aspect, of course, alongside the bond markets. We all know the US is now, its financing of its economy is more driven by capital markets than by the banks. I think the US market, it's around 65% of the funding is through capital markets. Only 35% is through banks. In Europe, it's now close to 50-50. And we in Africa, at only 5% of our funding of our economies is through capital markets. So we've got a huge challenge. And so we have three pillars that we use to drive this, to try and meet this challenge. Of course, trying to instill best practices to a certain extent, good practices we call them versus best practices, but good practices, working with different partners as we've listed here. And of course, we try and as well put our money to work to support the development of our capital markets, and that's through using guarantees in particular, and also sometimes some credit lines, but mainly guarantees to support the introduction of instruments in specific markets, be it for the housing market or just for corporate bonds, even for governments. And finally, alongside that, we all know that there's this, as we always say, funding has to have the capacity building attached, because in a lot of ways, you've got to make this sustainable development. We don't just want to do one-off things. We want to make sure that we put in place the right institutions, and we allow that the training of the staff there is adequate for them to actually pérenniser, as we say in French, sorry to use that word, but we make sure that we have, this is sustained over time. So we have a pillar that is linked to capital knowledge management and capacity building. And this we work a lot with regulators. It's mainly with the public sector, because the private sector we consider, of course, we work with them, but we hope that they are sufficiently rich to be able to support the capacity building that they want to undertake with their clients. Here, I'll just give you one or two examples so we don't go too far off track, but I just wanted to make sure that you hear that we have one or two things that could be of relevance to you. First of all, the knowledge work that was developed through the African Financial Markets Initiative. We have this huge database on capital markets in Africa. It covers, we have actually 43 liaison officers in different countries, and we thank all our countries who support us through central banks, supporting us create this centralized document. You can find that on www.africanbondmarkets.org. There's a D missing in the bond in this presentation, sorry. So that way you can find a lot of information. And of course, we've actually introduced a new vehicle, the ETF, an ETF, the only ETF only existing ETF currently for African sovereign bond markets. It's actually, you can buy, if you buy into it right now, you're actually exposing yourself to 8 countries. And we launched that in September 2018. It's had a very good run. It's denominated in dollars and listed in the Rwanda Stock Exchange. And we're actually going to be listing it in Botswana, hopefully in the spring of next year. And after that, hopefully in Nigeria and then in Egypt. But anyway, in a nutshell, what I'm trying to say there is that we're really trying to help the introduction of new instruments. We are invested as well in this domestic bond fund. So as I say, we try and put our money where our mouth is and make sure that we do also lead by example in terms of showing that our investments also support certain innovations that we hope will take up and become much more mainstream on the continent. Finally, we have put together, we've recently launched a capital markets development trust fund, which has been crucial in our support for West Africa, which is our pilot phase for the next 3 years. As I mentioned in my opening statement, we consider the capital markets is very relevant to the regional integration agenda as well. And of course, the AELP is part of that. But in the CMDTF that we currently have, we're working a lot on integrating ECOWAS markets between the Francophone zone and the Anglophone zone, the fragile states with the more richer countries. And this goes with, there's a lot of financial infrastructure work that is going on in that space, alongside supporting the authorities in being up to speed in terms of their knowledge of the new and exposure to the new technologies and the new instruments that are being proposed. Here you have the context of the contacts of the team on the AELP and beyond the AELP is Mr. Diarra, who's the manager, Mr. Akin, who's also working, who's the task manager on the AELP, and of course Tom is actually on the line here, who's running the project, out of Nairobi. I'll stop here. Thank you very much, Jim.
Thank you, Stefan, for your presentation. And yes, this did it did really help to fill out a lot of the gaps and questions which I had. I think there was a phrase in your presentation where you said you spoke about a one-stop shop, and if you think about the sort of a marketing spin, if you like, to the linkages project. It's one of these kind of frictionless things, or if you lower friction for you, and which allows you to invest across the various markets on the continent. So I'm really excited and looking forward to what comes out of the process that's currently ongoing. So once again, thank you, Stefan. Let me move on to our next, our final presentation. The presenter is Mr. Mark Dunley-Owen. Mark will be discussing our topic, obviously the African fixed income landscape, but from the perspective of the investor. I think I must say I'm looking forward to hearing from you, Mark, being one of not many active fixed income managers operating on the continent currently. So I can't wait for your presentation, and please begin whenever you want to.
Thanks, Jamil, and good morning or good afternoon, everyone. I'm also going to try and share my screen. I'm going to start with this slide, which, as I said, it shows the Nigerian one-year Treasury bill yield. and it's a period from 2008 until September 2020. So that's the red line, and the gray line shows the Nigerian Naira US dollar exchange rate. And what's most noticeable about this chart is how volatile the yield has been. So you can see that the red line has moved from at times 1 to 2% to at times 20+%. And that volatility makes it very difficult for some investors to invest in Africa. Because if you think about most fixed interest funds, they are looking for stability, they are looking to provide income for their clients. So if you have an instrument such as this, now must remember, this is a 1-year instrument, so it should have very low duration. It's issued by the government, so it should have relatively low credit risk, and yet it has been incredibly volatile over the last 12 years. So as I say, it does limit the audience for Africa. The flip side for that is for people like us. So we are, as Jamil said, we are long-term active managers. We target absolute returns. So for people like us, volatility is good. And why it's good is because it gives us opportunities to buy things when they're cheap and sell them when they're expensive. And a good example would be if you look at the 2016 and 2017 time period, and you can see then that at the start of 2016, the yield on Nigerian T-bills was less than 10%. And over the next 12 to 18 months, it went up to around 18%. And over the same period, the currency was devalued. So it was devalued from 200 Naira to the dollar to 360 Naira to the dollar. So at the time, there was a lot of worry about Nigeria. If you remember back to 2016, the oil price had fallen to about $30 a barrel. The Nigerian GDP was contracting, so it was a negative print, which was the first time that had happened for 20 years. And there was generally a lot of uncertainty in the world. So very few investors were willing to go in, or foreign investors were willing to go into Nigeria. For us, we thought it was a good opportunity. We were able to buy a 1-year bond at a 18% yield in a currency that had already been devalued. So the currency we thought was not overpriced. And at the time, we put about 20% of our fund into Nigerian T-bills. And as you can see what happened subsequently, it has been it's done well for our clients. So that's the good side of Africa, and that it does give you opportunities. The bad side is best shown by the last year on the chart. So if you look there, you can see the red line's basically gone straight down, and yields have gone from about 10% a year ago to currently the yield on Nigerian T-bills are about 1%. And if anyone saw this chart and didn't know much about Nigeria, they would think that things are going really well. They'll think that the oil price is at $100. They'll think that the Nigerian economy is booming. They'll think inflation's low. And yet we all know that none of that is true, right? So it's actually the opposite right now. So what has happened is that, unfortunately, the regulators in Nigeria have become more involved in the market, and that has distorted both liquidity and therefore yields in the market. So there's a lot of excess liquidity in the market, and for various reasons, both banks and investors like ourselves can't get our money out the country right now. So we're forced to keep it in Naira and invest in instruments like T-bills, and that's driven the yields down. Now that's frustrating for local banks. I'm sure they would like to do more with their balance sheets. It's even more frustrating for investors such as ourselves who, you must remember, we have an African mandate in this fund, and in some funds we have a global mandate. And there are a lot of opportunities across the continent. However, right now we're in a situation where our money's in Nigeria. We can't get it out because there's not enough dollars. We are forced to hold it in Naira, and we are worried about the Naira. We think the Naira is overvalued. And we are forced to invest in an instrument which is offering a negative real yield. So we can invest in instruments anywhere from 1% to, let's call it 10%, depending on the instrument, but inflation's at 14%. So it's a negative real yield, the currency is overvalued, and we have no liquidity. So that is bad for our clients, and that unfortunately will impact our returns. I think the more important point is that there will be long-term implications of this. So there's a famous saying that capital markets have a very short memory, and in some cases that's true. But for people like us, we have a long-term mindset. So I think that over the next 6 to 12 months, I think Nigeria normalizes. I think yields and the currency normalize, and we will be able to get our money out. But the hurdle for investing in Nigeria going forward is going to be higher. So we're much less likely to put our money into Nigeria in future, given our recent experience. And that's bad for our clients, but it's also bad for the development of the Nigerian market. So that sounds quite negative, but that's definitely not the case. I mean, what is interesting is that despite these risks, despite the regulations, despite the volatility, one can still do very well by investing in Africa. Stefan talked about the domestic bond index, but if you look here, so the gray line is a return of US 3-month treasury bills plus 4%. And we think that's a good return. We think most investors would be happy with US treasury bills plus 4%. And in fact, very few funds have given that sort of return over the last 5 to 10 years. And this chart shows from 2013, which is when our fund started. And the red line shows the Allan Gray Africa Bond Fund, and the blue line shows the Standard Bank Africa Sovereign Bond Index. And you can see both of those have outperformed US T-bills plus 4%. So they've both done better than what we think is a very good return. And that just shows that despite the risks, there are definitely opportunities, and you can do well investing in Africa. The one caveat is that you have to have a long-term mindset. You can see how volatile the red and the blue lines are. And I think for anyone to invest in Africa, you have to be patient. And if you are patient, I think there are definitely opportunities. So then I'm going to close with, we often ask in these sort of forums, we ask for what is a wish list that you as investors would like to see to help the markets develop. And the truth is there's no short list of things that we think would fundamentally change things quickly. But the way I like to think about it is that I like to put, I think there are 3 important stakeholders in any market, and that's the investors, the authorities, and the issuers. So the investors are the people who have the money, the authorities are the people who make the rules, and the issuers are the people who want the money. And what is, I think what will help these markets is that all 3 of these stakeholders try and focus on a few things. And I put 3 things here. I think if all these stakeholders could be long-term, transparent, and contrarian, I think the markets will be better over time. So what I mean by long-term, well, I already talked about how you have to have a long-term mindset if you're an investor. I think it's very hard to do well in a volatile market like Africa if you are not patient. But I think it's even more important that authorities have a similar mindset. So if you think about when you're making a rule, when you're deciding on regulations, you're never going to please all the people. So there's always going to be a benefit, and there's always going to be a cost. And some people are going to benefit, and some people are going to bear the cost. And I think, unfortunately, many, many times, the benefit is a long-term benefit, while the cost is more short-term. And I can think about many examples in South Africa where we all know what the answer is. We all know what needs to be done, but the benefits will only be realized over the next 5 to 10 years, and the costs will be realized over the next 1 to 2 years. And the best example would be the electricity provider ESCOM, which everyone agrees something needs to be done, it needs to be restructured, and the debt needs to be reduced, but no one's willing to bear the cost. No one's willing to, and the cost will be probably higher electricity prices and staff layoffs in the short term. So I think, unfortunately, especially with officials, if you're democratically elected, you have to focus on your electorate, and that means you have to worry about the short term. But the more the rules can be made with a long-term mindset, the better they will be for the markets, and the more the markets will develop over time. And you can say the same about issuers, right? I mean, we often get questions on where should issuers fund themselves, and I think the answer is really fund yourself for 10 years. So rather than looking for the cheapest funding over the next 1 year, find funding that will be there in the good times and in the bad times, and develop relationships that will last through the cycles. And transparency is a similar idea. I mean, I think we all know what I mean when I say we need to be transparent. I think it's important that if you have investors, you've got to be clear what they are getting. They are not getting a stable 2% a year return. They're getting a more volatile return, but also they're getting higher rewards for that risk. Authorities as well. I do find it really surprising. The current example is Zambia. Zambia, we all know, is going through some difficulties making payments on the Eurobonds. And despite that, they're asking for various concessions from the funders, but they're not willing to tell the bondholders or give them the details that they need about who that funding comes from and what the terms are. And now I understand that it's never that easy. So I'm sure there's probably some of the other funders who aren't willing to disclose the terms. But for us as public market bondholders, the more we know, the more we trust the issuers, and the more we're likely to invest in the markets. And then finally, just to end off, so contrarian just means, so one of the hard things about Africa is that no matter how much you try to do the right thing, sometimes things happen that you have no control over and have a big effect on your life. And the best example is commodity prices, right? Unfortunately, the continent is very dependent on commodities, particularly oil. And if oil falls, then no matter how much you try to do the right thing, it is hard to get people to invest in your markets. The point here is that you have to think through the noise. You have to think, what is the right thing to do, irrespective of what the short-term noise is. And we try to do that as investors. We try and invest when other people don't want to, because that's when the opportunities are the best. And I think if authorities and issuers had a similar contrarian mindset, I think it would be more likely that the markets would develop over the long term and be better both for us, or for all three stakeholders, for the investors, for the authorities, and the issuers. So I'm going to stop there and hand back to Jamil.
Thank you very much, Mark. I think your presentation certainly brings home some of the challenges and opportunities, really, that I think we started the series with. I think looking through your eyes, we see exactly what those challenges are and sort of how we can navigate them. And I think it also accords with something that Tapuloko said in the past series, where he spoke about volatility, at least the way Allan Gray looks at it, as something which is not it's not always a bad thing. It's something that you can take advantage of if you are willing to be contrarian and patient. That brings us to the close of the presentations for this series. We have a period now where we're going to be taking questions from the audience, and I see that a number of the questions have already been preloaded. I'm going to look through these and read them out, and I think I'll put them to somebody or one of the speakers. But if one of the other speakers really has something that they would like to add, please, you're more than welcome to do so. Okay, so let's start off. I think the first questions I have here are posed to Celestin. By the way, Celestin, welcome back, and I can see you're still with us now. So the first question is really, what is the role of public debt managers in developing markets such as those in Africa to develop the market? And specifically, who in these markets should be responsible for driving that development? I suppose there's a question there about responsibility, but also specifically the responsibility of public debt managers in the development of those bond markets. Then there's an interesting question here, because I suppose following on from your comments about Zimbabwe, the question says that given the unstable policies in Zimbabwe, which you spoke on, specifically on the currency reforms from 2009 to date, how do you explain the outstanding performance, is what the question says, the outstanding performance year to date in US dollars of the Zimbabwean capital markets in comparison to other African capital markets? So I suppose the question there is trying to understand or trying to reconcile the comments around the currency challenges or currency reform challenges you spoke of, and the return of the Zimbabwean market very recently. So Celestin, those are the two questions put to you.
Okay, thank you very much. I think I'll go with the first one. The first one, if I understood well, has to do with the development of the bonds market, right? Yes. So whose responsibility will that be? I think there's something that was mentioned by the previous speaker, the immediate previous speaker. It goes along all the regulators. Okay, it goes with. It can't happen with one-sided story. It has to be a concerted effort, actually, involving the regulators, which is mainly basically the central banks, the capital markets authorities, and then you have to get the views of investors out there, and the market players, other market players, meaning intermediaries. So I think the development has to be one agenda to make sure you develop. And you develop something that is going to be good for everyone in all of the stakeholders. Because at the end of the day, if some of the fragmentation we were talking about earlier, for example, in some of the markets, are caused by rivalries between maybe the exchanges or the regulators or the central banks. Why we have a parallel market when we are already fragmented enough. We are talking about markets being small, for example. Enough as in our countries, different countries, and then you fragment them further by creating a parallel market. Some of them are talking about OTC, others talk, whatever way you call it. At the end of the day, if you don't have enough clout, you will not have enough traction for meaningful investors, for example. So now, if we look at it from holistically, I think we can work together. Both the regulators and market intermediaries, and on equal plate, actually. They have to be on equal basis when you are discussing issues of development, because at the end of the day, what matters are service providers, regulators. At the end of the day, the end consumer matters also at the same time. So I think everyone has a role to play. And if working together, they can achieve the development we all desire. Like, the investor was telling us, our friend, I forgot the name, but the investor is looking for a return, and the issuers are looking for the money. The regulators are making the rules. So if you are not really working together, how are you going to be able to come up with something that is going to be suitable or good for everyone? So I think there has to be strict and a balance out there. So on the issue of Zimbabwe, I was trying to, I think maybe I was misunderstood. There was an issue of some policies that sometimes change matters in our markets when you have policies which are not necessarily aligned with the current goings. I'll go back to that. There was a policy that went against actually the was 2011. Let me go back to my presentation here. Okay. So it was an issue which was trying to address the issue of the of policy making. Sometimes when you make a policy and then at one point you change in the middle. So I think that's what happened when I was talking about. Maybe I think I gave an example of the Zimbabwean markets at the time, because there was a lot of volatility, like I was saying earlier. So when they adopted the USD as a major trading currencies, it was abolished in 2019, but they introduced it recently, I believe. So there was some policy that was put in place, then was contradicted by the market forces at the time. But now I think they have created a new exchange, which is we are yet to see how it is going to be evolving. So I think maybe that's the issue. It had to do with, the capital flow, actually, policy, so when you are doing restrictions and stuff like that, sometimes also, where, the policymakers and the marketplace, they don't necessarily work in the same direction, yeah.
Yeah, no, thank you very much, Celestin, for answering those questions. I'm going to move on now just quickly to the questions here for Stefan. I have three questions for Stefan. The first one being a question around, with the AfDB being sort of the premier DFI on the continent, I think the questioner would like to understand what other initiatives do you have to develop the local currency yield bond markets on the continent. So that's the first question. The second question, perhaps a little more technical, and I don't know how much of this you can get into at the moment, but the question is around how the linkages project is going to deal with the bond, the fact that there are, there's bonds or fixed income and equities. How are you going to manage the obvious differences in how these two things or these two asset classes trade and so on? And then the third question is really a question about, I guess, the philosophy here. So the questioner poses the fact that global exchanges are consolidating at the moment. And the question they put to you is, should we rather not be thinking about consolidating these exchanges as opposed into one or two giant exchanges, rather than having this sort of network or linkages where the existing exchanges still remain? So I think those are the three questions. I hope you got that.
Yes, thank you. I'll start with the last one, by the way. Might as well go backwards. On the last one, I'd just say, first of all, it's linked to, let's face it, there's consolidation, but all these former stock, the Bourse in Paris is still there, the Bourse in Amsterdam is still there, they're all still there. They're just basically cross-shareholding, right? So the question then becomes, to what extent are our stock exchanges either privately owned, or they're run by, they've got the partners that are opening up. I know there's been a lot of conversion of some stock exchanges now to be more, to be listed, in fact, have their own, to be publicly owned. So the question is between publicly versus privately owned stock exchanges, how this would work across the continent. And definitely what we're looking to do is obviously going to contribute to eventually this type of cross-shareholding to exist, which will lead to, in a way, to consolidation. You'll have more specialization of certain bourses versus others. I don't think we're there yet. As Celestin mentioned, there's just been the opening of the Victoria Falls Stock Exchange. To be honest, I don't know what they're trading. It would be interesting to know how they're going to link up with just the Lusaka Exchange and others. So I don't think it's running against the tide, but I think on the contrary, it's going to complement and actually reinforce eventually the need for the consolidation, because of course, by the fact that you're linking up these different exchanges, it means you're going to be harmonizing procedures and processes. And also you'll be actually helping legislation become much more business oriented, which is also part of the challenges we're facing right now, but we're getting there. On the second question, how the linkages, it is relatively technical. I won't go into the details, but I'd say one of the responses is actually that we created this Association of Securities and Stockbroker Association, an African Securities Dealers and Stockbroker Association, to actually help us tackle that. The whole point is to see, because of course they have their vested interests. Of course they have a cost structure that is different. And in each market, they have different cost structures. So these are things that are obviously being challenged by the fact that we're looking to interlink these markets. Is going to actually put a lot of questions to the different regulators and to the different stock exchanges themselves on how they're functioning, are they cost efficient, and are they competitive in the way they're running their operations. Of course, the CSDs are crucial as well in this discussion. So anyway, so it's not a very detailed response, but it clearly is definitely something that we are considering, and is obviously we're hoping to tackle it through this working with the stakeholders and making sure that they are part and parcel of the conceptualization of this linkage project. Finally, to the first question about what are we doing to develop local bond markets or local currency markets anyway. More generally, I would say there's two levels to this. Let's face it, Zambia's rate's around 30% right now. Would you issue a bond at 35% to 10 or 15 years? I wouldn't. And I wouldn't advise them to. So it's going to cost, it's going to handicap generations down the road on such a costly borrowing. So the point is, I'm just saying this to illustrate that, and I know a lot of the rates have come down. Nigeria's, as was mentioned by Mark, Nigeria's had a very authoritative approach, if I may say, to fixing where the interest rates should be at the moment. But it's The bankers are not very happy, but it's for certain people, of course, it is working out because you can borrow much cheaper. 10 years. 10-year rates are below 10%, if I'm not mistaken, now in Nigeria, which is quite new. So anyway, we'll see how that is obviously impacts the market. So anyway, so my point is, first of all, what is the level of interest rates, and are we actually through the yield curve structure, are we actually encouraging bond markets to play their role for corporates? That's one question we have to ask ourselves, and then we have to say, who should the discussion take place with? Is it about inflation targeting? Is it with central bank only? Is it with the government? It's with both. It's all of these policymakers. We have to understand what type of yield curve do we want to achieve? Who do we think it's going to benefit to, and why do we want to have it of such a structure? And what in the yield curve is structurally difficult to address, and what is not? So that's a discussion that's on the policy side that has to happen. Alongside that, there's two levels. There's another two things I would like to mention. One is about when you're talking about these fixed costs linked to the issuance on the local markets, because we don't have information asymmetry, we don't have the information, there are no rating agencies, et cetera, to provide us comfort. But of course, that's going to add additional cost to the borrowers. So the point is, we also have to work on, and some of us are working on it. We have to work on putting in place that financial infrastructure that's going to enable in the future this to be a much less tedious process and much more, let's say, advantageous for the corporates to actually borrow in the markets versus going to the banks. And let's be honest, a banker, if you're a banker on the continent, in a lot of cases, you don't want to securitize your loan. You want to keep it on your books because you want to keep the good borrowers on your books. You don't have that many good borrowers on the books that you're going to want to securitize and actually put into a bond structure. So the point is, we have to make sure that there is enough information, be it the local rating agencies, credit bureaus, and this is where the digitization agenda is extremely crucial. And this, we've seen it in East Africa, to what extent it has changed the consumption and also the credit habits and the possibilities of accessing credit for many people and even SMEs. So I'd say that there's a whole discussion around financial infrastructure that is crucial, and payment systems, obviously. Finally, to the last point, how does the bank work on these things? Well, the bank will use let's say there's two tools that we use more generally, because we have different audiences that we're trying to address. We have regulators, we have the private sector, and we have SMEs, and we have well, those are the main ones. So we have to be able to use our products differently. One that we use a lot is the guarantees. Guarantees are going to be the ones that we use, let's say, generally speaking, with the introduction of new capital market products on the markets, because we believe that by providing guarantees, of course, bring comfort to the investors who want to now innovate and work on different products, invest in different products on their market. So there we do use the guarantee instrument. Alongside that, we do a lot of grants linked to capacity building and creating awareness, and also sometimes some government lending to support financial sector reforms in the capital markets. And this is linked to the financial infrastructure agenda I was mentioning a bit earlier. So really, just to say that there are several different types of interventions with different instruments, and depending on the country, they'll have different partners we work with, and also we will have a role that is more, let's say, will be more leading or will be more following, and it depends which country we're working in. Thank you.
Thank you very much, Stefan, for I think a thorough answer. So I'm going to move on to Mark to put some of these questions to him, and I think he'll have to decide the extent to which he can, the extent to which he's going to respond to some of these questions. I think the first one is really about a broad question around, do you think investors are prepared to accommodate alternative bond structures in Africa? And one of the examples they give is zero coupon bonds. I suppose there are other things like inflation-linked bonds, etc. But the general question is, are investors willing to accommodate alternative bond structures in Africa? Then the next question is, really about, it says that in the fund description, I'm not sure which fund, but it says in your fund description, you do not hold West African bonds and in brackets, Ivory Coast, Senegal, in local currency as of the end of October, but you hold them in foreign currency. Then the question goes, are there any structural or infrastructure issues that explain this situation? So question on why you do not hold local currency West African bonds. And then the final one is maybe just a question around what the what you think the impact on some of the more African bonds. I guess example here is Zambia, but there may be others. But what the impact, given the fiscal challenges as a result of COVID and all of this, what you think the likely impact is going to be for some of these African bonds going forward. And I suppose that would be the sovereigns primarily, but you can talk about any ones you think make sense. So Mark, over to you.
Thanks, Jamil. I'll start with alternative bond structures. So I guess I'm going to separate us from the rest of the market, because we, as Jamil started off in my introduction saying that there aren't many active asset managers who manage money like we do. So from our mindset, we are willing to look at anything. And if you would issue something like a zero coupon bond or a linker, it just comes down to risk versus return. So if the return is appropriate, we'll definitely look at it. However, I think a big requirement for many other investors is liquidity. And unfortunately, anytime you introduce something that's non-vanilla, so introduce something that's new, it's likely to have low liquidity. So I would love to see more structures. I don't think the yields are going to be sufficiently attractive for the issuers to issue them. So I think it's one of these chicken and egg things where you need to pay up to get it started, and few issuers are willing to do that. But over time, I think the more structures you have, if they are liquid, it definitely helps. I mean, you can look in South Africa's case; they have a relatively liquid inflation-linked bond market, and that has helped them fund themselves in ways that they wouldn't have been able to do otherwise. And then in terms of local currency in West Africa, so I guess if you look at Ivory Coast and Senegal, those are the part of they have the CFA franc. So once again, it comes down to risk versus return. And in those two countries' cases, the currency is linked to the euro, so it's relatively stable. And because it's a relatively stable currency, the returns are relatively low for obvious reasons. So what we do is we look across the continent and we say, where are our best opportunities? And historically and right now, we haven't felt that the CFA franc bonds, so let's say Senegal or Ivory Coast, the returns were sufficient to invest there. It doesn't mean we won't. There may be times when that changes. I mean, to give an example, right now, the Senegal Euro bond is about 6% yield in a hard currency in dollars. And the Senegal local currency is the same. It's about 6% yield in a CFA franc. Now, if you completely trust the CFA franc, you're to either. In our case, we think that there's more liquidity in the Euro bonds, and we think there's a low, but there's some risk in the CFA franc, and that you never know if France will stand behind it forever. So it's not, we don't avoid it, but it's something which we just base it on returns and look across the continent and put money where we think the returns are the best. And then finally, Zambia. So that's a tough question. I mean, what do I think the long-term effects of what's happening right now could be? I think it really comes down to the country. Zambia is in a tough situation, and I think the next few years are going to be very hard. I hope that there's constructive engagement, and I hope that the debt is reset in some format. The terms are changed, and they're able to move forward from a much stronger starting base. I think the biggest worry I have is what happens to the rest of the continent going forward. And I think we all expect Zambia to default. The question is, do other countries follow Zambia? So do we have a situation where there's a rolling crisis across the continent? So Zambia defaults and then another country, whether it's Angola, Ghana, Nigeria, whoever it is, do they follow and do they stop paying coupons on the Eurobonds, and then do some of them eventually default? That would be incredibly negative for Africa. I think you would lose any funds that remain in the continent, or foreign funds would leave, and it would take a long time for investors to get over the damage that causes. So I really hope that doesn't happen. I don't think it will happen. I think most countries all countries are much stronger in a much stronger situation than Zambia are. I do, however, think that the next few years are going to be different to the last few years in the African bond markets. If you look at any macroeconomic metric, I think 10 years ago, South Africa was starting on a very good base. The metrics have progressively got worse over the last 10 years, and in many cases, the metrics are now stressed. So I think the availability of capital and the rates that were available over the last 10 years are unlikely to be repeated going forward. Now this, I'm talking about the public markets. I think the DFIs or bilateral funding is a different market, and there may be more opportunities there. I definitely think there will be opportunities, and we still hope to make attractive returns for our clients, but it's going to be a different world over the next few years compared to the last few. So I'm not sure if that answers it, but yeah.
Thank you very much, Mark. And I think those are, I think we're running out of time now, and I'm going to, if I may, bring the event to a close. If there are any unanswered questions at this stage, you will get those answers by email. So please look out for them if your question hasn't been answered. And just before we close, I'd just like to make the following announcements. I think this is obviously the end of the second series of a series of 4, all of them involving this, speaking broadly about the theme of investing in Africa and thinking about it from different perspectives. I think in today's theme, which was really focused on fixed income, we saw some of the themes that began at 2 weeks ago in the first of the series being developed, and specifically through the fixed income lens. And there's the next in the series is going to be on the 25th of November. That one will be discussing specifically the African institutional investors. So if you've not registered for that, please do so. I'm sure it will be quite worth your time. I want to say thank you to all the attendees for joining us and spending about an hour and a half with us. I hope it was worth your time. I certainly enjoyed it. I also want to thank the speakers who shared the virtual stage with me. Thank you very much for your contributions and for engaging presentations and for all the answers which you provided. And the last, certainly not least, people I'd like to thank is the wonderful team that helped to put this all together. Thank you, Kitty. Thank you, Lydia. Thank you, Nomhle. And certainly thank you, Lebo. We looked really good because of all the work that you guys put in. And then just in closing, when you switch off or when you log off, a survey will pop up. Please can I ask the attendees to complete that survey, because it helps us with the feedback we need to do better in some of these series. I suppose with that said, that's all from me. Thank you very much. Stay safe and bye-bye. Cheers.